So I hear a lot of people talk and they're pretty proud of the fact that their accountant got them down to zero taxes. Is zero taxes really my goal? Is zero taxes really my goal? Should it be my goal?
Zero taxes is definitely not the goal. That is absolutely for sure not the goal. In the earlier stages of a business, though, the beginning cycle of a business, we want to try to keep the tax burden off your shoulders, and usually we can do that through the equipment purchasing you do. There's a lot of depreciation that's kicked off in the earlier years, and we want you to reinvest your funds, but you have to start building up those cash reserves and that working capital initially. Once the business enters that maturity phase, after 5 years, we want you to pay a substantial amount of tax. That's our absolute goal, because if you're paying taxes, you're making money. And so again, initially, we like to keep the taxes off your back, and then going into that process of maturity to pay more tax. And we are, honestly, with the tax rates that we've had, at least up to now, we're in a very low cycle of taxes. So this is a good time, a period of time to pay taxes. One of the things, we work with a lot of farmers. Farmers are, generally opposed to paying taxes. They hate taxes. But a lot of times what they'll do is they'll leverage themselves so much to get out of paying taxes through buying additional equipment and taking on additional debt. If things go bad, if there's a bad year, which in agriculture there are bad years, and in construction contracting there can be bad years, you're so leveraged that you basically have killed your company. So again, paying taxes, upon that point of maturity in a business, that leads to success.
I think the banks probably like to see that you've paid some taxes. That's an indicator that you're actually making money. If you're 5 years into your business and you've never paid a dime in taxes, that's probably a pretty good indicator that there's a problem.
Absolutely.
I would say.
I would say for most banks, if you're not paying taxes within 2 to 3 years, they're looking for a way to unload you as a client. Mm-hmm. They don't want you as a client. So the goal should never be to pay zero tax. That should never be the goal.
I've not paid tax and I've paid tax. I prefer paying tax.
Absolutely.
The times that I didn't pay taxes, those, like I say, were not happy fun times. Those are pretty dark times, honestly. So let's talk about cash flow, because I think there's a lot of people that don't really understand what cash flow is. The story I think about is how Amazon got started, and the only reason that they got to where they are now was because of cash flow. So how did Amazon survive losing money for I don't know how long they lost money, at least 12 years. How did they pull that off?
Cash flow is very tricky. It takes years to actually understand a statement of cash flow. It's basically broken down into 3 segments. You have your cash flow from operation. That's what you charge your customers, what you pay for your materials, and what you pay to your employees. That's how much cash is left over. And that's the most important component of cash flows, is from operation, because that's basically what has to be utilized to service your debt, to make your debt payments, and to purchase equipment. That's the cash, and to build your cash reserves, to build your working capital up. So that's the most important, being able to control your pricing, your job cost, and your employee cost. That cash flow from operation is what drives the company. And then your cash flow from investing is usually an outflow, because that's typically your purchasing of your equipment, your machinery and equipment. And then you have your cash flow from financing, which is also important, because that's your borrowings less your debt payments. But your cash flow from operation is what drives all that. And see, where these companies like Amazon have made out very well is because they have investors. They sell their stock. They have stock sales. So that stock sales, just like an owner's contribution into the initial contribution in the business, that's a cash inflow from the investors putting money in. So like a lot of these Fortune 500 companies, the people that are involved in the stock market, they have their stock for sale. So they're bringing cash in, generating cash in, just like Tesla. For years, they never showed a profit, but they have people buying their stock for the potential of profit. So they bought at a certain price anticipating that that stock would go up. Same thing with an owner in his business. So an owner, he needs, his primary focus should be investing in his business, putting money back into it, not draining his business of cash flow.
So we can also generate positive cash flow. I'm just thinking of construction. So if I don't have to pay my supplier for 6 months, but I'm going to get paid from my customer, I'll get a deposit before I do anything. That creates positive cash flow, but that can catch up with me later on. And that's how I think a lot of people get into trouble, right?
Yeah.
Because one of the things we hear people about is taking a bunch of deposits, and then when it comes time to do the job, they have no money to actually buy the materials because they never allocated them.
And the same thing with debt, because some people, like especially construction contractor, you need this piece of equipment to do this job, so you end up borrowing it. If you don't have the cash, you end up borrowing funds for it. But then if you have a blip where your cash flow from operation decreases for whatever reason, your profit margins, there's more competition, there's just not as many jobs. If your cash flow from your operations, if it decreases and you have the same debt load, then you go into a negative cash position, and you have to be very careful. That's why debt a lot of times is a bad method. In a mature construction business, we like the construction contractor to purchase most of his equipment unless there's some interest play there. If interest rates are low enough and the terms are good enough, we don't mind financing of equipment. But a lot of times we like the owners to be able to take their cash, their cash reserves, and buy the equipment with it. And I really do believe, over the next few years, we're going to be trend lining towards increase in interest. And again, that's another reason for currently building those cash reserves and that working capital.
So, James, I think there's a lot of companies, and the bulk of the companies are probably doing under $3 million. I would say a lot of them are doing under $1.5 million. What type of structure would you potentially recommend to a contractor if they were in that under $3 million range?
We have both S-Corps and C-Corps as clients. It used to be that C-Corps were very favored just because of the benefit structure. So you can have significant benefits to the owners that run through a C-Corp that did not through an S-Corporation. The trend line then switched to S-Corporations. And one of the benefits of an S-Corp is if you have multiple owners, that tax burden is spread out amongst those owners. So it generally produces a lower level of tax. Now with the corporate tax rate at 21%, there's some benefits again to being a C-Corp. One of the things that we do not like about the C-Corp structure, though, is there's a concept of called deferred income tax expense. So that's the difference between like book and tax depreciation. And that number can be significant, and that ends up being a liability on your books, which is it's a painful process for us in that calculation. So we like that venue of S-Corps a little bit better. So we're trending still towards the S-Corp venue. We know a lot of accountants though that are recommending, in startups, the C corporation, because currently the tax rate's 21%. It's they're trying to raise that though, it sounds like, to 28%, which makes the C corporation a little bit more marginal. In the C corporation also there's double taxation. So you're paying tax on the corporate's profits, and you're also paying tax when the owners take it out either through salaries or dividends. So there's a double taxation that ends up happening on those profits in a C corporation.
So S-Corp, you talk about S-Corp, but there's two ways that we can go about being treated like an S-Corp, right? We can do that through S-Corp, and then we can do an LLC that's treated as an S-Corp.
Yes, that's absolutely right.
Do you lump all S-Corps, LLC, and standard S-Corp into the same group?
Yeah, because the benefit of being an LLC in making that conversion to an S corporation is you don't have the minutes and the meeting requirements that you do inside of a corporation. So you lose some of the formalities of a corporation. But for tax purposes, they're identical. There's no difference in that taxes. They're both flow through entities in that venue. So.
And as an LLC, you have the option of being a standard LLC, or you can take an S-Corp election, right?
That's correct.
What's the difference between those, real quick, for the people that might not understand?
So like in an S corporation, the way it works is the owners have to take reasonable compensation. So like, there's publications of what owners in a construction contractor businesses should be taking as compensation. And as long as you're paying yourself reasonable compensation. The dividends that pass through to you are not subject to self-employment taxes. Where in an LLC that hasn't made that election, all of the earnings, as you know, are subject to self-employment taxes. So you're paying a huge amount of Social Security taxes on your earnings in a LLC.
So when we started SWI, we waited for a period of time and just made that election like 2 years ago.
That's right.
Like,
yeah.
Because
for years you were just an LLC.
And then finally flipped to where it was
Yeah.
more advantageous to us to do an S-Corp election and save those taxes.
Yes,
those
that's
employment
correct.
taxes. So.
Yep.
So there's been a lot of debate. I've seen some debate on Facebook and some of the groups that I've been in. And what is the best way to purchase equipment? Is leasing the best way? Leasing versus buying equipment? Kind of explain that and maybe what the advantage is to one.
Personally,
versus the
I'm
other.
not a fan of leasing. What ends up happening with the construction contractor, when you purchase a piece of equipment, for book purposes, we usually assign a 10-year life to that. So it depreciates out straight line over 10 years. So you have a significant amount of equity, because remember, equity is part of the equation for the pre-quals and for the bonding also. So it's not just your working capital, but your overall equity is important. And to own a piece of equipment, depreciate it over 10 years, we retain a significant portion of that equity in that asset. On leases, you have no equity position. Yeah, we get to expense the lease payments off, but there's no equity position in that. And a lot of times what we're seeing is with those leases, even if they're capital leases, the interest that they're charging, it's a hidden interest and exorbitant. It's way higher than what you would ever pay by financing that piece of equipment at a bank. And so we are only advising our clients to lease equipment when the terms are very favorable. Sometimes they come out with lease programs, on a piece of equipment, whether they're trucks or whether they're semis or whether a piece of construction equipment, they come out with really good terms. But typically we only like to see that on like short-term rentals. So say you need an excavator just for a specific job. Well, we don't want you buying that just to do one job unless you foresee that need for it in the future. Mm-hmm. So on those, there's exceptions where we like to see a lease if it's just for a short term or one job. We don't like to see you doing purchase on that. Outside of that, though, we like to see the purchase versus the lease, unless there's, and again, some extraordinary thing, 0% interest or whatever that would come through, on a lease program.
Most of those, my experience with those has been is the interest rates are just crazy high.
They're crazy high.
And it seems
almost always. And it's hidden. Uh-huh. They don't even tell you. A lot of times we have a hard time. We have to run an amortization to see what exactly the interest you are paying. And a lot of times it ends up being 19 to 21% on those deals because it's a hidden interest. You're just buying basically a payment, but the interest is crazy high on it. And that's a trap of leases.
And I think a lot of what I saw, when we were doing some of our leases, it was because maybe the credit wasn't there. Mm-hmm. There's less underwriting on leases than there is going through a bank, so the bank's going to be scrutinizing that a little bit more. And so the reason that they're willing to do it is because they know some of those are going to go bad, but they're charging for it. They're charging a way higher interest rate. So
yeah, I have a lease right now. A client that has a lease. They're leasing actually 3 items. The interest rates are in that 16 to 18% on them, and there is no remedy. They can't even buy them out the way the lease is structured. They can't even buy the lease out. They have to wait until the end of the lease term for the buyout, which ends up putting them in a really bad position. But they didn't read the small print of the leases, so you have to really be careful.
There's a lot of those, even if you pay it off early, you still owe
all the interest. Yeah. Absolutely.
So it does you no good to pay it off early. So let's talk about job costing. You've mentioned it a couple times throughout the interview. What's job costing? Why is it important? Why should I do it? Is it worth all the time and effort that it takes to do that?
Job costing for a construction contractor is absolutely critical. You have to be able to track your revenues for that job and the specific costs, the direct costs of it, like the materials, the labor, the subcontracting. You have to be able to see if you're making a profit on those jobs. And each contractor, like in your industry, there's a specific gross profit margin that you should be shooting for. Highway contractors have a different one. Electrical contractors have another. So you have to be familiar with what that gross profit margin is. So that's your cost less your direct expenses, what that margin is to be profitable in a business. And one of the things that we tell our construction contractors, you should budget. Each job should have its budget, and you should be comparing that budget to the actual cost so you can see on a monthly basis if something's going south. A lot of times, like on the contractors that we only meet with once a year, we will see jobs that have went south, and it's too late to correct them if you're not monitoring that. As an owner, you want to be monitoring that on a monthly basis to see if you're within those parameters so you can see if you're making a profit. And one of the things we mentioned earlier is uncontrolled growth. One of the things we've had construction contractors that went basically from, doing $4 million of business to doing $10 million of business in 1 year. And there are significant growth pains with that because you're adding a significant amount of overhead. To be able to do all that, you're adding more employees to it. So you're adding overhead burden to that. And you need to be able to track that job cost. You can see what that overhead factor is so that on upcoming jobs, as your costs continue to rise, you're passing those on in your bidding requirements because you don't want a job that loses money. So you have to know where you are, and job costing is part of that process.